And what happens now?
Yeah, that's what I was going to ask. We know that you have this residual effect.
Mm-hmm.
There are people who were using those programs, even if it wasn't necessarily a hardship caused by COVID. And so we know that there was regulation released recently that talked about, we're going to extend that 6-month period. So how do you guys see the residual effects of this credit utilization for the forbearance agreement impacting today, tomorrow, and mortgage lending in the future, and primarily mortgage, not even on the lending term, but when we look at housing as a long-term wealth gainer for your families, for it's a home. Like at the end of the day, we're looking at homes. People live there, and so how do you see all of this culminating right now?
Yeah, the Assistant Secretary of HUD recently released a letter that said, we are now going to extend the COVID forbearances to any borrower who is facing a hardship, whether it's because of loss of employment or another hardship.
Mm-hmm.
So it really opened the door for the mortgage servicing industry to have that tool back in their shed, where we thought come May, that tool was going to be gone. So that's a good thing for mortgage servicers, because they're going to be able to keep their borrowers out of foreclosure. But as we discussed in our last session, we've been seeing record consumer debt. So there's a lot at play here, and I think that really ties in to where are we headed in the bankruptcy realm? How is that going to affect foreclosures going forward? Because we've just been seeing consumer debt skyrocket like it's never done before.
So Scott, what are you guys seeing? In your vision?
So I'm going to add to what Ben said a little bit and maybe say it a little differently. And that is, I think what happened in 2008 fundamentally changed the way that lenders and servicers deal with their borrowers on the mortgage side. That was such a shock to the system. I think the lesson that was learned is we can never end up in this situation again.
Right.
And if you pull that forward to COVID and beyond, and this was happening long before COVID, the knee-jerk reaction that said, if a borrower is 60 days, 90 days in default, we're foreclosing. I think those days are over. I think that the banks, I don't want to say learn their lesson, because it's just, it's a fundamental change to how the business model.
Right.
And the forbearance agreement and a loan modification program is always going to be the first and the second and the third option now. I think nobody wants to initiate a foreclosure if there's another way. So
it's an expensive process.
It's an expensive and lengthy process, and I think what history has now shown is there's maybe a better way, at least from the bank's standpoint and for the larger economy. So COVID certainly reinforced that and allowed them to use some of the tools and the lessons that were, learned along the way, and it allowed us to get through what could have been a very, very turbulent time.